All right, ladies and gentlemen, we're about to get this thing started here. Hi, everyone. Thank you and welcome for tuning in. We still have thousands of people joining right now, so I'll take a second here just to make sure everybody can hear me. There's no audio issues or anything of that sort. I'm looking around the Zoom. Cameras seem to be doing well. We got some thumbs up. All right, folks. My name's Rodrigo Cerda. I'm your moderator for today's town hall meeting. I'm absolutely thrilled to be here on Zoom with all you and some of the brightest minds in financial research who have managed to stay green through these uncertain times. Because even though 2022's dire market conditions have rattled plenty of investors, today's event is all about how we can help you protect your money and even profit from what's happening. I've hosted dozens of events for Benzinga readers in the past, but really nothing quite like this. And you won't find any fancy production here. To be frank, we even had to scramble to prepare this urgent message for you, given the historically poor state of the markets. Chances are you've seen some of the headlines from the mainstream media noting the worst bond market in 200 years, the crypto collapse, NASDAQ crashing by 30%, and of course, 40-year inflation records. Cash is a trap. Even safe investments and traditional inflation hedges like precious metals are reeling. And yet your money has to go somewhere. That's why we've put together this presentation for you guys, all right? Because the old cliche that there's always a bull market somewhere is still true today. And we wanted to get in front of you to let you know our best ideas and that we're here to help you ASAP. Because as history shows, like the 18-month dot-com collapse in 2000, 2001, market conditions can always get worse. As if we haven't had enough pain already over the last 2 years since COVID began. Headline after headline, the Federal Reserve is even saying there's going to be more pain ahead. And over the last month alone, the market is down another 10%, with some analysts now predicting the market could collapse another 22% or more from here. We have chief market strategists from TD Ameritrade, Goldman Sachs, Morgan Stanley, all calling for the S&P to fall to pre-pandemic levels, to as low as 3,000 points, even 2,900 if the Fed continues to tighten up and raise interest rates from here. That's pretty much erasing 3 years of progress and the money you've made in the blink of an eye. But we're here to show you how you can stop the bleeding in 2022 and give you a clear path for the coming months, even years ahead. Keep in mind, this will be the only place our top analysts will be giving away their #1 strategies for the rest of 2022, completely for free, and give you their insights on new opportunities that they're looking at today. We'll also get their thoughts on inflation, interest rates, energy, stocks, crypto, options market, everything, a whole lot. And I know it's tempting to sit on the sidelines at times like these or to go entirely cash and just wait however many months or years it takes for the markets to rebound. But cash is a big loser at a time when everything around us is getting far more expensive. Inflation still sitting around 8.3%, while the cost of some groceries have soared more than 100% just in the last 2 years. And so many families are starting to scrape the bottom of the barrel. Last quarter alone, American bank account deposits fell by a record $370 billion. According to CBS, 56% of US households said they're experiencing economic stress due to inflation. Right now, nearly 1 in 6 American households are behind on their electric bill. The median 401k balance is just $35,000. Now, if you're watching this, my guess is that you're in better shape than that. But if you're over the age of 60, you're probably wondering, how many more hits can my retirement savings take? When are you going to retire? Or are you going to need to be coming in and out of retirement to support your family and yourself? I know that at this time, when precious metals, cryptos, US Treasury bonds are returning less than inflation, it feels like a no-win situation. Moving your money from one asset to another is like moving out of the frying pan into the fire, as the saying goes. But what truly is remarkable is that despite everything going on around us, this year, Benzinga's top analysts recommended 66 trades that have soared over 100% or more. And that's why we're so confident that despite all of the uncertainty that you may be feeling right now about what may come in the economy and our markets, we're going to show you how 2022 could turn around for you, maybe even end up as one of the best years you've had since the 12-year bull market died. We've read every email from our readers, YouTube comments, feedback. and you guys calling into our customer care department. We're here to help. And if this is your first introduction to the Benzinga family, let me, Rodrigo, be the first to welcome you here. As you're about to see, our analysts all have diverse opinions on the markets. You're about to be briefed on each of their best ideas for the rest of 2022 and beyond. So if you haven't already, take a moment, grab a pen or a monitor, pull up a Word document, because you're going to want to take notes for this, okay? So let's get started by meeting your expert panel. Joining me today are four of the most well-respected investment analysts in the world. You might recognize our very first panelist from CNBC, Bloomberg, The Exchange, The Close, and several other leading financial networks. He got his start on Wall Street in the 1980s with Salomon Brothers, and today, currently a chief market strategist at Miller Tabak. He also runs his own stock picking and swing trading service here for Benzinga. Matt, thanks for being here.
Rigo, thanks for having me. It's such a great time to be doing something like this. The markets are, needless to say, volatile and in turmoil. But the greatest thing that we have right now is, unlike other times when we've had this turmoil, the individual investor hasn't had the tools to take advantage of moves in both directions. And I think we're going to talk a lot about that today. And I think this is going to really be a perfectly timed event like this town hall meeting is.
Absolutely, man. Can't wait to get to it. Next up, we have Anne-Marie Ban. Anne-Marie began her career as a neuroscience researcher. Today, she's a two-time author, founder, and CEO of thetradingbook.com. And she's a frequent contributor to our Benzinga Pro research platform, where she spends every day in our chat rooms showing our readers up-to-the-minute trades they can make for pursuing quick, potential double and triple-digit returns. Anne-Marie, welcome.
Happy to be here with all of these gents. We're going to have some great ideas and thoughts for everyone.
Absolutely. It's going to be great. We're also joined by four-time financial author Tim Melvin, who's written a series of famous financial books for the Little Book of Investing series. Tim has been managing money for over 30 years and currently runs a growth investing portfolio for Benzinga readers. Tim is our number one authority here at Benzinga when it comes to valuing stocks. And Tim has one of the most impressive winning streaks that we've seen. Starting in 2013, he went on a 62 winning streak over an 8-year period. Impressive. Tim, we're pleased to have you here today. All right. And looks like we're all good there. Hey, all right. And then lastly, we're joined here by Benzinga's head option trader, Chris Capri. Chris doesn't stop at just recommending nimble option trade to our readers. He also runs a school to teach readers everything he knows about options, including how to collect income from stocks that triple or quadruple what their regular dividends offer. He's also the founder of his own trading firm called Second Skies. Chris has been trading every investment imaginable over the last 22 years, everything from stocks, crypto, Forex, options, and more. During his days on Wall Street, he was so successful, he was known as a gold client manager, meaning that he handled clients with $1 million or more. He's also currently working towards his PhD in neuroscience. So Chris, you and Anne-Marie are essentially both neuroscience researchers?
Yeah, I actually just found that out this week. So I am going for my PhD in neuroscience, behavioral neuroscience. But today I'm here to talk about option flows, where they're positioned, where the institutions are lined up, and how that's going to influence the market and what trade ideas we have on that.
Great stuff. Well, all right, everyone. So we have a lot here that we want to cover for everyone tuning in today. So we need to keep things rolling here. Matt, let me start off with you. Of course, everyone, please feel free to pitch in. We're doing this 100% live, so I'll try my best to keep everybody here on track. All right, first question here. All right, so I'd like to start with an open discussion about inflation. We know that right now, everything around us is getting so expensive. I'm reading stories about people making worse dieting decisions, going out less because they can't afford it anymore. Do we see this getting any better anytime soon? A lot of people out here could really use some relief to their wallets. Matt.
Well, Rodrigo, I think we will get a little bit of relief on the inflation front, but the problem is that I think it's going to remain elevated for quite a bit of time. The situation, this is a supply induced, most of it is supply induced. And the demand destruction that the Fed is doing can only do so much. I mean, whether it be on the energy side, where we've underinvested in the extraction of fossil fuels, and we all know, we all want to get away from fossil fuels, but we can't do it in the next 2 years. It's going to be 20 years or more. So those prices are going to remain high. Plus, of course, we have the situation in Russia, which doesn't seem to be getting any better. So those sanctions are going to remain on. And then, on top of that, we have food prices, which are extremely high, because we have the breadbasket of Ukraine and Russia, and natural gas prices, which is essential into the getting a fertilizer, which is, again, all these things are going to keep prices high. Again, for supply reasons. It has nothing to do with demand. You still have to eat, and you still have to heat your home. So these are going to create some problems further as we go along. And the last thing I just mentioned, we're starting to see wage inflation, rear its ugly head. You just saw last week with the rail strike being settled with an immediate 14% increase in wages and eventual 24% increase over the entire contract through 2024. So these prices are going to remain high. That means the Fed, as President, former New York Fed President Bill Dudley said today, they're going to stay higher for longer, even if we reach peak inflation, and even if interest rates do top out at some point in the coming months.
Right, that's definitely an interesting take here. I'd like to get a couple of opinions in here. Anne-Marie, what do you take overall on the inflation concept? And Chris, Tim, you guys feel free to pitch in on this. I know you guys have a lot to add on it as well.
As far as the actual inflation event, all the things that Matt talked about are driving it. The big argument now is whether it is going to stay at this elevated level or it's going to pull back. And really, we don't know. We can estimate and we can think about that for a bit, but we really don't know until we know, because there's all kinds of unknown unknowns. So from my perspective, I'm not really a great one to talk about that as much as someone else, simply because from my energy perspective, I'm thinking, wow, I can't do anything about all the inputs that are making it happen, that are keeping it high. I can just look at the markets and see what it is I need to focus on. And maybe, Tim, you can talk a little bit about how that affects investments in general when you're looking and trying to choose where to look when you've got inflation rearing its head like that.
Well, I think you go back and you look at the 1970s, the playbook's there. I mean, what worked in the 70s? It was energy, it was real estate, it was infrastructure that produced cash flows. Because I'm kind of with Matt, this is going to stay higher than we might hope. We'd have been a lot higher on the August numbers if we hadn't been draining the strategic petroleum reserve. Yeah. And guess what? Probably. We're going to stop doing that now. So that's going to take a lot of oil back off the market. And you're coming into a situation in Europe where they could be on the verge of a full-blown energy crisis that's going to keep prices high over there. So there's a lot of inputs, including rents, that could continue to go higher. This isn't going to be the easiest thing Jerome Powell's ever done. And I have to suspect that this is the worst $200,000 a year job in the history of the world. And he's got to be missing being in the much easier than this private equity industry at this point.
100%.
Yeah. Jim, I think your comparison to the 1970s is so perfect, because that was exactly what we had then, a supply-induced issue with the oil embargo from OPEC. And it's obviously a little bit different, but it's the same in that it's supply-induced and therefore much harder to
your comments on energy are just so much. It's like we've never talked before today, but you said exactly what I would have said, because the energy part of this is decades of just really, for lack of a better phrase, moronic energy policy. Because if you really look at this, all right, we can't get to carbon net zero by 2050. Look at our own governments, the people that are telling us we're going to carbon net zero. They're projecting that in 2050, we're still burning way more oil and gas than we are using renewables. I don't think we can get there in 50 years.
We'd all love to get there tomorrow.
I'd like to be there tomorrow. That doesn't mean I can make
Exactly.
a wave a magic wand. And
Right.
I'm hopeful that my grandchildren see carbon net zero. I sure as hell will not.
Right, right. And I'd like to get Chris's comment on inflation itself. Chris, what do you think about all this situation?
I think the inflation is, as everything that Matt had suggested, supply side. I think we also have to look at the fact that the Fed did an enormous amount of printing and that the money supply kind of created this carry trade out there, which was short volatility. So with the Fed printing money, they definitely inflated assets beyond what they were, what they should have been. And I think we're starting to see that right now. A lot of these stocks have come down to valuations that were much more normal for them and that they shouldn't have been at. And so I look at that and I feel like, I don't see the inflation issues abating anytime soon. For me, everything right now is about inflation and rates. In the bond market, in terms of option volatility, the MOVE index has stayed elevated for months now. And, we're kind of approaching, where we were in 2008, 2009 levels. So when the bond market stays that elevated, then there's clearly worry in the markets. There's a lot of worry about future rates going forward. So we have to look at this as these are the two issues right now that are driving the market, inflation and rates. And so I don't see the inflation issues that we have right now just being fixed in a month or two with a magic wand. We have to fix our supply chain domestically and globally. We have to, shift resources towards, back to the US. And that's going to help tremendously on that front. But we also have the global supply chain issue, which is also going to continue to have an impact on it. So, this really forces us as traders to deal with this. And how can we profit from this if cash is losing value and being eaten away at inflation? That's an important trade for us.
Right, absolutely. I love the strategy that all you guys are applying to this. Thanks for mentioning interest rates there, Chris. That takes me to my next question. Interest rates. Since inflation and interest rates are tied hand in hand, we can move on to this other question that we have for all you folks. Tim, I'm going to start with you on this one. I think a lot of people are getting worried about rates moving higher. Rates were as high as 6.5% around the dot-com crash and about 5.25% during the financial crisis of 2008. In the last 12 months, we've gone from near zero rates to more than 2, and in less than 2 hours from now, we'll see. We could see rates over 3% after the Fed's announcement. Tim, is this the time to panic?
It's never a time to panic, Rodrigo. If you panic in this business, you're dead. Okay. If you panic when things are going down or you get too elated when things are going up, you're never going to consistently make money. And it took me a few years to learn that. So that's the voice of experience. But should you be concerned about rates going higher? Absolutely. The Fed officials themselves are saying 4.25. They may well be low. Okay. Remember what Volcker had to do to get inflation under control. Fed funds touched 20 for a brief period of time. That would be devastating to us. So yeah, you got to worry. I think Fed funds are going to get to 4.5%, maybe 5% before this is all said and done. That impacts your stock investments. That impacts your bond investments. Don't panic, but it's time to start putting together a strategy to deal with rising rates because they're not stopping anytime soon. And every single Fed official that has spoken in the last month has told you not to expect any rate cuts next year. So they're going to hold them up there until they get back down towards that 2% level. So yeah, you've got to factor that into your thinking now.
Right, absolutely there. Matt, I'd like to get your opinion there on interest rates. You're pretty zoned into that as well.
Yeah, I mean, one of the things that, Tim, completely agree with Tim on this. And one of the things that people need to understand, though, too, is that even if we didn't have inflation, okay, which we, as Chris talked about, we had because the Fed kept the liquidity spigots open too long. So we were going to get at least some anyway. But this war in Russia, this invasion by Russia of Ukraine obviously exacerbated the situation quite a bit. But the Fed was always going to have to tighten. Remember, they went to zero interest rate policies. and a huge QE program. And they boosted, in other words, they took interest rates to abnormally a low level, below their natural level, and they took the stock market well above its underlying fundamentals. Now, we knew that they were doing this, and we said that's going to be fine, because eventually, when the thing calms down, the Fed will stop providing all this liquidity, and the economy will catch up. The problem is they didn't stop the liquidity, as Chris mentioned, and we haven't been able to play catch up. So at some point, they were always going to have to tighten policy. They always have to get interest rates back up to a natural level. They're always going to have to get valuations levels back down. And now that we have this inflation issue, they have to keep those rates higher for longer. I don't want to get too much into the weeds in it, but the one thing I guess I would want to make on this is that the bond market is the one that's usually right, and the bond market is not fighting the Fed as much as the stock market is. Eventually, the stock market is going to play catch up, or should I say catch down to the stock market, to the bond market. We have to get back to those neutral levels. That neutral level is now higher in interest rates than it was a year ago because of all this added thing of inflation. I don't want to sound overly bearish there, and we don't want to be panicking at any time. It's going to provide some unbelievably great buying opportunities, but higher interest rates are not good for the stock market. Don't fight the Fed. Don't fight the Fed. Don't fight the Fed.
The great words there from Matt Maley. I keep hearing those all the time. Chris, Anne-Marie, do you guys have anything to add here on this particular question before we do move on here to our next segment, our next question?
I don't have anything. I feel like we all covered it pretty well. I really appreciated all the topics that Matt covered and Tim covered and Anne-Marie covered. So yeah, I feel good. I feel like we've done a good job of that.
Great stuff, man. I love this session. So we have, we're moving on here to our next question about bonds and really what they tell us about stocks. There's an old saying on Wall Street, the bond market is smarter than the stock market. And if that's true, maybe everyone tuning in today should pay close attention. What a lot of people tuning in today probably don't know is from the year 2000 through March of 2020, bonds actually earned even higher returns than stocks without any of the massive losses. Stocks do tend to suffer in times like these. But as of the first 4 months of 2022, the US bond market was obliterated. Long-term treasury bonds lost more than 18% without adjusting for inflation. This marked the worst bond market performance since 1842, nearly 200 years ago. So starting with Matt, bonds have always been such a good barometer for stocks. And what do they tell us today, Matt?
Well, again, it goes back to one thing I just said was that the bond market is not fighting the Fed anymore. It did for a while. It's no longer doing that. And that makes it tough for the stock market. But one of the things that I really think is important too is that there was so much free money. We had those zero interest rate policy, so much free money out there. That is disappearing, okay? So people need to remember that. And that free money is disappearing. That's less money for private equity, less money for venture capital, less money for meme stocks. And I know this is self-serving, but I'm telling you, that's going to be when we finally bottom out, we wash out, and the market becomes a great a buying opportunity. Without that, we're not going to have that free money. What we are going to have is good stock pickers out there like us, and that's going to be an unbelievable premium. It's an unbelievable premium now, but it's going to even be more so in the next bull market because not everything is going to take off like it did in 2021 or March of 2020. It's going to be a stock pickers market, an options player market, individual names, and so I guess my point is that what is the bond market telling us? It's telling us we're going to be looking at some great opportunities, but we're going to have to be a little bit more intelligent about how we go about it.
Right. Absolutely. I love that response. Tim, you're zoned into that particular measure as well. Any thoughts on bonds in the bond market?
Yeah. I mean, look, at the heart of every valuation model that everybody's ever taught in any business school anywhere is interest rates. It's a major component. What the bond market is telling us right now is stocks are worth a lot less than we thought they were. So the indexes are going to be a painful place to be for a while because rates are not done going up. The no profit all story inflated tech stocks that we saw in 2020, that's over because you can't justify the valuation at all anymore. So the bond market's clearly telling us and that the way ahead for stocks, it's going to be pretty tough. And, we've watched the stock market fight the Fed, and I can still hear Marty Zweig saying that on Wall Street Week back in the 80s, as you say that, Matt. Has the stock market's been trying to fight the Fed, and that's not a fight they can win. So the bond market's telling us the stocks are going to get cheaper. However, if you're still in the accumulation phase of your life, markets going down are great news. You should, don't be upset. Pop a champagne cork. Things are about to get fun.
All right. Great
Along-
response there. Yep. Sorry there, Nick. Go ahead, Chris.
Along those lines, we've been talking about bond market and bond volatility. So, I look at the options market for bonds and bond market volatility. We have to understand that from 2010 to 2020 pre-COVID, we had an incredibly, we had this like low volatility situation in the bond market. The MOVE index was just oscillating between 50 and 100. And there was just very little volatility around that. When you have that kind of low volatility environment for bonds, that's great for stocks. Since COVID, we've seen that regime has changed. We're no longer between 50 and 100 on the MOVE index. We're now sitting between 100 and 140. And the fact that it's staying elevated like this, the bond market is saying, look, there is more challenges for the stock market ahead. Until that volatility in the bond market comes back down, we have to assume that there's going to be more pressure on stocks. That has to resolve itself for the stock market to kind of resume this next bull trend. So short term, it's going to be elevated. We think it's going to be elevated for the rest of the year at a minimum, maybe even through the first half of next year. But for right now, the MOVE index is saying, look, this is unresolved. This is going to be like this for months ahead. So this is kind of a key indicator for us on the option side here is the MOVE index in relationship to bonds.
Absolutely. I love that, Chris. And all right, so let's, I think we kind of covered the bond market there pretty well. Let's move on here to our next question, safe haven assets. All right, everyone. So typically, when markets are down, people rush into safe haven assets like gold. What do we think about safe haven assets like gold, silver, or even just sitting on cash? Anything else that comes to mind? Anne-Marie, let's start with you this time.
Well, safe havens and the word safe haven, we have normally looked at bonds, we have normally looked at commodities and things like that, but that kind of portfolio has really been hurt dramatically because as the dollar rises, we are seeing gold not catch a bid. And so that hasn't been safe. And we know that the bond market hasn't been safe because you just talked about it being routed. So really, as I look at things from a traditional space where you look, there haven't been any real safe havens, as it were. But I was just talking to Tim, and he's got an incredible space for us to look in new ways into the space that we would call the safe haven for now. So, Tim?
I've got two places that I think are going to be safe havens during all this madness. The first is my favorite. I have a deep love of junk bonds going all the way back to the Michael Milken days, okay? And the sweet spot of the junk bond market is the BB rated bond, all right? That bond historically has outperformed the lower risk BBB and above. It's also outperformed the single B and below because of much lower default rates. Now, you have to do this with individual bonds. You can't do it with bond funds, all right? You need to have a stated date of maturity where you're going to get the money back. The default rate, even in a horrible recession on BB bonds, as you're going to see by some of the names I threw out here, is negligible. So you got a pretty good pretty good assurance you're going to get your money back. So just looking at this, I grabbed a few examples just right before we came on air of things that you can do right now. Going to totally avoid stock market risk. They may go down with the bond market. There's a stated maturity. You're going to get your money back on that maturity day. So like Anadarko Petroleum. Now they were taken over by Occidental, Warren Buffett's favorite company to buy right now. So the bonds are guaranteed by Occidental. They are a 3.45 coupon due 7/15/2024, a little less than 2 years. Right now, they're priced at a discount to yield 5.5%. Okay.
So
That beats what the stock market's probably going to do by a long shot. Icon Enterprises, Carl Icon's companies, these are car dealerships, real estate businesses. They may not, be wonderful businesses for the next 2 years. Icon's got the cash on hand to pay these bonds back. 9/15/2024, right? Just about exactly 2 years. This bond matures. It's 4.75 coupon, due 9/15/2024. It's a 7% annualized yield to maturity. So that's just two examples of safe havens where you own a company that is almost, if you don't get paid back by these companies, the loss of that money is the smallest problem you have.
So where
we're almost dead at that point as a country if they can't make the payments. So this is a total safe haven. You need a broker who knows the way around the bond market a little bit. You use the Morningstar FINRA database to search for these things, and you can see the latest prices. And that will help you folks make sure that your broker does not rip you off on the bond pricing, because I know this will be a shock to everybody listening. Brokers have been known to mark these things higher than the market and put the difference in their pocket. So you want to be checking prices. But double B bond market, double B and double B plus, stay away from the double B minus because you've got more risk of a downgrade there. Double B plus, you've actually got momentum towards an upgrade working in your favor in many cases. And then the other safe haven is just goes so against conventional thinking that I love it. You would think that mortgage REITs, particularly agency mortgage REITs, would be in danger of going a lot lower as rates rose, except it's already priced in. If you look at Annaly Mortgage, NLY, agency mortgage spreads are now at the highest level they've been in decades. They've blown out to just historic levels. And Annaly's done something else really smart. 15% of their total portfolio is mortgage servicing rights, which they don't just move higher when rates go up, they rocket ship higher. So you've got built-in protection in the portfolio to protect you against any value destruction because of rising rates. It's paying 14.5%. It's at $6 and a couple pennies. Probably won't ever trade much higher than 7, but I'll sit there and collect 14.5% for the next couple of years all day long. That's higher than the historic rate of return on stocks. The dividend itself is well covered by cash flows and gives you quite a bit of protection against any destruction to book value. But as I said, those mortgage servicing rights are going to more than hedge off most, if not all, of the interest rate risk in the portfolio from rising rates. So there's two places that's outside conventional thinking a little bit, but both of them are going to be places where you can make a little bit of money and be assured that you're going to get your money back. So if you're in the distribution phase of your life, these are the kind of things that you really want to be thinking about right now, not necessarily what tech stock to try to pick a bottom in.
Right. Anne-Marie, anything you want to add on there?
No, I just wanted to ask Tim if he could just spend 2 minutes once again saying we can either connect with a broker. We can't buy any of these directly from our normal platforms. We would need to connect with our broker to help us facilitate the price of the acquisition of that.
Yeah, this is not really, you're going to have a hard time doing this online. You're probably going to have to call, even if it's a discount broker, if they have a bond desk, you should be able to call and talk to them and get an accurate price on the bond. And, you want to talk to the bond, get some recommendations on who is pretty good at dealing with the corporate bond market.
Excellent.
So yeah, you're not just going to be able to go onto Robinhood and buy these things. It's a little trickier.
Okay. All right, folks. And I just want to remind everybody, we do have a ton of actionable strategies that we'll show you as we go through this from all the great panelists that we do have here. Great insight. So I guess that kind of leads me here to the next question. What is the immediate solution? Plus, splash crypto there. But all right, so let's get this moving on, folks. Back in February, at the start of the Russia-Ukraine war, Warren Buffett issued a warning. He said that during wars, gold, Bitcoin, and cash are bad bets. In fact, he said stocks are the long-term solution, and something to the tune of how during every war he's known of, stocks seem to do pretty well. But my question to all of you, starting with Chris, if stocks are the long-term solution, what is the immediate solution? And also, since we're mentioning Bitcoin, how do we feel about this space? Chris.
Yeah, that's a great question. I think right now, one of the immediate solutions, I think there's many and we're all going to offer some. So I believe options offer us a lot of opportunities to kind of deal with this. Generally, most pension funds, most mutual funds, and most traders that are listening on this podcast right now or on this webinar right now, they're long equities or they want to be long equities as a whole. But if equities are continually going down, then how can we, neutralize or reduce some of this risk? Or how can we make money while the market is going down? Yes, we can trade these inverse ETFs. We can do that. But we can also use options to do that. We can use options to hedge or neutralize the risk on our long stock trades. We can trade long volatility on stocks. VIX is negatively correlated to SPYs. So that gives us an opportunity there. We can trade volatility on single tickers if we want to. We can make money with volatility increasing. If we expect volatility to continue to increase in the markets, we can make money on that while getting the direction wrong. So I believe options offer us a lot of solutions on how to do that. There are some tickers and sectors that I want to talk about when we kind of get into what we think is going to happen a little bit later on in this discussion here. But I think traders need to start looking at how can we incorporate options into our trading in our portfolio? How can we neutralize the risk on some of these tickers? Maybe you got Amazon and you like owning it at $120 and you don't think it's going to go down that much. Great. If Amazon does go down, how do you plan for that if you're going to hold on to it? Do you want to just eat those losses? You don't have to. We can use options to neutralize the risk on this. So short term, I think we want to be incorporating options. I don't think it's the only thing we want to do, but I think it's something that we want to incorporate into our trading.
Absolutely. Couldn't agree more with you there, Chris. And we have our next question here about options, which is, I think, a great place to kind of get going here, folks, because our readers love options. So let's take our time here, okay? Let's move on here to options trading. Chris and Anne-Marie have pointed our Benzinga readers to a string of winning option trades over the last several months. And that's extremely valuable in times like these when inflation is swallowing up dividend income, bond yields, and just about every traditional investment. I even read back in late 2021 that options trading had become so popular thanks to the pandemic, it had started to become more liquid than the stock market, overtaking it. Going back to 2019, roughly $100 billion were flowing into options trades every single month. By the end of 2021, that number was approaching $600 billion. And you can see why. Not only can a single options trade deliver more income from a stock than it pays in dividends in a year, but you can collect it while taking on less risk than people who buy the stock outright. And with so many new traders involved in the space, what do we think about the state of the options market now? What opportunities do you see for people out there? Anne-Marie, lead on with this one, and then I'd like to get Chris's take on this one. Then Matt and Tim, feel free to chime in.
Okay, so I love the option space, and I love it because there are a lot of ways to make money. So let me start with a statistic. About 70% of all options expire worthless. So you might think to yourself, wow, if I buy an option, that might be a problem. Yes, if you're sitting in the wrong strike. And so that's why you've got folks like me and Chris that are nearby. And right now we are in a bear market, and in bear markets, prices that go up will come back down to test support floors. And so one of the things that we got very spoiled by in the last few years was buying every single dip we could find. And we are seeing a lot of that just roll over and have a ton of failed breakouts and all that sort of thing. And so one of the big things that I want to stress to folks here today, most importantly, is that slow is fast. And what I mean by that is pay attention and be more selective about what you choose in the option space and where you position in the option space. And the way you're going to do that is by learning more about it. And the great fortune that Benzinga Pro has is having Chris inside of our environment where he teaches us all the things that are critical to understand about positioning. So positioning is one of the things that I want to talk to Chris about, because he's got some really clear understandings of how we look for the right options. And that is because of price flows and the size of option flows in the market. So Chris, help us bring all that together.
Yeah. So you had mentioned that for a while, for about a decade, we had this kind of buy the dip environment. And we have to understand that this is where the options market really steps in and kind of explains some of this. So why was every dip being bought in the markets? Well, not to get too deep into the woods, but when you make a trade, if you make a large enough trade, the option dealer market makers on the other side of that trade, they're not trying to stop you out. They will actually just hedge that position to neutralize the risk. They want to collect all those transaction flows. And in like the last month, we did almost 800 million contracts. So just think about the money you could get if you were an option dealer market maker collecting all these transaction spreads. We were in this buy the dip environment. We were in this positive gamma environment. And basically what that means is that because of how the dealers are hedged, when the market goes up, the dealers are actually going to sell. But what that means is that when the market goes down, the dealers are going to buy. And that's why the buy the dip worked so well, because the dealers basically just had a buy order underneath the market that as the market dipped, they were buying that because they had to for their hedges. 2022, that flipped on its head. We've now flipped from positive gamma to what we call negative gamma. That means their total book is set up in such a way that when the market goes up, they are buying that. So they're trading with the market now, not trading against it. But on the same token, that means that when the market sells off, they are selling that as well. That exacerbates the downsides, that increases volatility, and it pulls liquidity out of the market, which creates this negative feedback loop of markets moving lower, traders buying more protection, markets moving lower. So that's the environment we're in right now. And that's why the flows are kind of creating this, exacerbation to the downside. And when we look at the flows right now, going into this FOMC, the market is heavily aligned in terms of the puts. There's like at least 2.5 puts out there for every one call out. And when we look at the flows, we can see the positioning very clearly. There's some flows tied to this end of the month kind of expiration, September 30th, but there's very little call interest until the October OPEX and the December OPEX. Why December? We have elections in November. And so that's going to create kind of this influence. So looking at the flows in the options market, we expect volatility to remain elevated and keep a bid for the months to come, at least through December and at least through the elections. But right now, the options market is kind of dictating because it is so large. You mentioned 600 billion at the end of 2021. We're past that. Every single month this year has either been the highest month on record in terms of option flows and contracts, the second highest, or the third highest. That tells you that options are becoming bigger and bigger, and therefore they're moving the space around more. And so even if you don't trade options or don't want to trade options, you have to learn to pay attention to options on how they are moving the market. Super, super important.
Great
Chris,
stuff.
Chris, do you have the thought process around, you said, hey, listen, we've got this lull until the end of October, and then we're looking into December. Is that when you think the VIX is going to move out of this range? Are we sort of planning for the VIX to slip out of the current range that it's been sitting in that you and I chatted about a while back?
Yeah, that's a great question. I think this FOMC could do it by itself, depending upon if they go overly hawkish or if they end up placating the markets. If they end up placating the markets, I think the VIX has the potential to move, roughly 4, maybe 7 points down, but it's not going to be a significant amount because traders are still going to have to keep some bid on volatility to the October, and we got the elections, and the elections could have drastic, consequences in terms of policy and the economy going forward. So traders are still going to have to keep a bid in the market to some degree. If the FOMC comes out really hawkish, then that could kick us out of this range. And if we start breaking in the 30-32s, then that's going to drive put values, all these long puts we've been talking about, that's going to increase their value, and that's going to push markets lower. So I think this FOMC could do it. I think it's very possible this could unlock it. Either way, volatility is going to have to remain bid to some degree. we see until at least the October OPEX and likely December. After that, then I think traders are going to look for more, kind of rate guidance to see, what has the Fed done since then, since we only have, this FOMC and then November and December.
Thank you.
All right, folks, and we're going to move on here to the market strategy, where you're going to hear about the strategies of all of our amazing panelists. We're going to start here with Chris Capri. So let's go ahead and talk about market strategy. All right. I know that each of you have found several opportunities for our readers this year alone. So let's start with Mr. Chris Capri here. Recently, you've been recommending option trades on two particular investment vehicles: SPY, which is the largest ETF in the world, designed to track the S&P 500, and the VIX, which is sometimes known as the market's fear indicator. Your ability to accurately trade such a volatile market is amazing. You've recommended 4 trades for your readers in the last couple of weeks that have returned 36, 50, 54, and even a whopping 160%. Could you tell our listeners at home exactly what it is that you look for that makes your approach to the markets so successful? Chris.
Yeah. So my whole focus is on flows and positioning. My theory is this, working on the broker on the sell side and then trading on the hedge fund, the buy side, that the stock market is a ledger for all the orders. And when you put them all together, they're either going to be balanced or they're going to be imbalanced to the buy or the sell side. And that imbalance creates these directional moves. The option market affords us an opportunity to see very clearly where these flows are aligned. We can see where the open interest is aligned and at what strikes and how much. We also know through options that how the dealer is going to have to hedge based upon the position in the market. If the market's net long puts, then the dealers are net short puts. And then we know that they're going to have to sell the underlying to hedge those short puts to make sure they have no directional risk. We know that. We know that flows have reflexivity to it. Case in point, 2 examples that we shared with our Benzinga Option School members. On Friday, going into last Friday, we had a put heavy OPEX. That means that traders were long puts going into the OPEX. Well, when the OPEX, the option expiry happens, they have to get rid of all those puts. If they're getting rid of all those puts, the dealers are getting rid of all their short share hedges associated with that. So when you have put heavy OPEXs, that creates short-term rallies. What happened on Friday? We had like a 1.8% move up in SPYs from the cash open. So all those puts came out of the market. The dealers had to buy back shares to offset their hedges. That creates a short-term rally. That's reflexivity. So we look for these opportunities where we see these flows that are going to create these directional moves. Another case in point, we made a trade on Monday. We suspected that going into the FOMC, this is nothing, special or anything like that, that traders weren't going to make huge directional bets, that their things were going to stay relatively contained going into the FOMC. So we sold an iron condor thinking that the market's going to stay between a relative floor and a ceiling based on where the flows are lined up. And so that allowed us to say, okay, let's sell some volatility while it's elevated. If price stays in that range, we make money. We just close it out this morning for a profit. So we look at the flows and the positioning, and then we look at how can that create trade opportunities? Where is the strongest support and resistance? Where is the momentum likely to push? And how can we trade that based upon the hedging impacts? That is my strategy on that. Does that make sense?
Right. No, absolutely. And I think it's a very unique strategy there based on your background, Chris. I appreciate you going into the details to helping the folks out here. And so let's move on here to Anne-Marie's strategy. Okay, so Anne-Marie, you might be the most unique person here when it comes to interacting with our Benzinga readers. You started off as a neuroscience researcher. You don't come from a trading background per se, no formal background in the financial space, but yet you've learned the market flows and have been trading full time for almost 20 years. Now, you spend your day after day on our technology and research platform, Benzinga Pro, showing readers up-to-the-minute trade ideas. I mean, you're doing everything from posting YouTube videos with your thoughts on the markets to charts with such detail on exactly what you're looking for. Really easy to understand, right? And you've really helped a lot of people in our rooms, right? In Benzinga rooms. In total, you've recommended over 110 trades with recent winners like 83% on XLE, 126% on VRTX, 130% on TLT, 58% on USO, and literally dozens more. I guess, first of all, why are you doing this? What makes this so important for you? And could you tell everyone at home exactly what your approach is so they could better understand this? Anne-Marie.
Well, you know what? I'm really testimony to the fact that if you really want to learn this business, you can. Because when I came here, I had no skills, and I started with a very nice portfolio size. And in 5 years, I moved it straight down. And so my first 5 years, I lost a lot of money because I did not know how to look at price. And the same sorts of things that Chris looks at in a very deep and complete level, I look at on the level from the candlesticks. And so my thought is always about flow. Where is price moving and in what direction? Who's above? Who's below? And I put all that together and I say, all right, now let's take a look at what everybody else is thinking. So if I were to say my secret sauce, what that is, my secret sauce is that I look at the market and think, what is everybody else thinking? So that when they make their move, I'm either going to follow along because it's essentially what everything else, according to order flow, says is going to happen, or I wait until it reverses and they exhaust themselves and I move forward in that space. It's as simple as watching those candlesticks, seeing if they hold support, seeing if they hold resistance, and then saying, all right, let's watch them and see who packs the levy. And when it's safe, we'll go in. Now, does that mean I never catch a bottom? Yeah. Does that mean I never catch a top? Yeah. But I get that big fat piece in the middle that's safer. And so that really is the basis of everything. And I love explaining it because I had such a hard time when I started. I really was terrible. I'm just saying. I was abysmal. But I wanted to learn it so badly. And I loved that I could see all that emotion in the candlesticks and see when they were afraid and see when they were greedy. And I just wanted it so badly. And when I got it, I had to share it.
That's great. What an amazing story there, Anne-Marie. For all the folks, I mean, several people here already know you from the chat room. Okay, and we're moving on here to Tim's strategy. Mr. Tim Melvin, right now you're running an investment portfolio for Benzinga readers focusing on deep value stocks with massive triple-digit growth potentials. You currently have 7 stocks in your portfolio you recommend folks to buy today. You have one of the biggest winning streaks we've ever seen, 62 picks over an 8-year period without a single loser. So when you speak up, we're listening. In a recent video update for your readers, you said, and I quote, "Learn to love the down." Could you elaborate on that? What are you seeing in the market today that gives you the confidence to be a buyer? And what could you tell everyone at home to look for if they'd like to be buyers as well? Tim.
Well, I'm confident to buy. Now, remember, I'm only nibbling. We started with 7 positions in this new portfolio. That's nowhere near what I would consider to be a fully invested level. It'd be substantially under 50%. And, if you look at the bank stock portfolio that I maintain over on the MarketFi platform, we're holding right at about 30% cash. We came into the year with 50, bought a couple thrift conversions that drew that down a bit. But I'm a little more cash heavy than I might normally be, because when I look at the market, for all the reasons that we've talked about earlier, there's a pretty good chance stocks are going lower. But everything that I've recommended so far in that portfolio, I take a much longer term view of the markets than most folks. Okay. I'm approach buying stocks with more of a private equity mindset than a trader's mindset. I'm looking at that 3 to 5 year period. I want to buy a business, a good business, at a low multiple of cash flows or asset values. And in that 3 to 5 year time frame, I want the potential to double, triple, or more my money. I'm not really that interested in percentages. I always get such a kick out of it when you pick up a Wall Street research report, and this is a strong buy. We think this thing can go from 15 to 20. And my attitude has always been, who cares? If it's at 15 and I can't get 60, why are we talking? So the reason I'm confident you can get in and buy the stocks that we started with right now is when I look out 3 to 5 years, I easily see the path for all of them to be 3 to 5 times higher, almost regardless of what the market does, just based on the growth potential of the company. An eventual market recovery would be a welcome assist, but I don't think that happens till sometime next year. So really, we're just looking at businesses the way a private equity fund manager a good private equity fund manager might look at businesses, trying to buy cash flows for low multiples in businesses that have extraordinary growth potential. And this is, so far, it's worked pretty well for the last 3 decades.
Interesting stuff there, Tim. A lot of people are definitely excited to learn more about that. And all right, so let's move on here to Matt's strategy, Mr. Matt Maley. Matt, one thing Benzinga readers love about your work is how thorough and transparent you are with what you're looking at in the markets, and as often as you can. I mean, since September, you've recorded 7 different strategy session updates, totaling nearly 3 hours of insights into all the macro forces affecting people's money. Recently, you've shown folks winners like 250% on TQQQ, 100% on UPP, the dollar, a massive 850% on LabU, and a 280% on TLT. So I feel like you've got a fantastic pulse on the market here. Does your approach change daily, weekly? I mean, you've recommended 5 wildly different trades that you haven't even closed yet since the start of the month. Everything from tech companies to energy ETFs. What could you tell everyone at home about your approach to the markets and what you think they should do starting today, Matt?
Well, I think, first of all, those were all options trades. Just make sure that what we said, I didn't make a 250% on the TQQQ, but on options. But that's what the options can do. And one thing that Chris said earlier is that we have all of these. We now have the tools. We now have weekly options on individual stocks, 3 times a week options on ETFs. But we also have them on the TLT, which is the bond market, the HYG, which is the high yield market. The LABU is a sector. It's a 3-time leveraged sector ETF on the biotech industry. So that's what we do. But my strategy really involves using a lot of different things. Fundamentals are always important, but the one thing that they say that the worst saying on Wall Street is that the market is always right. The market is only always right eventually. I mean, obviously the market was wrong in March of 2009 when at the bottom. It was dead wrong at the top in 2007. So that and that's what we do. That's what the 4 of us do. We see these dislocations and take advantage of them. So again, the market is only right eventually. So I use the fundamental analysis, which is the backbone for everything, but also use the technical analysis, which is a lot of people don't realize is actually quite is based a lot on fundamental issues. Positioning that Chris and Anne-Marie both talked about. When you get too many people on one side of the boat, either side, no matter what the fundamentals tell you on a longer term basis, the short term it's almost certainly going to go the other way, or at least it's not going to go any further in that direction. And then finally, we look at sentiment, which when it gets to it, sentiment, people read too much into it sometimes when it gets a little bit bearish or a little bit bullish. But when it gets to extremes, again, it shows that too many people on one side of the boat, it's got nowhere else to go. When too many people are bullish, nobody left to buy. Too many people are bearish. There's nobody left to sell. At least on a short-term basis, you can see those reversals. So I really look for those key turning points, whether it be in individual stocks, groups, or even in asset classes. I mean, geez, we made our biggest trade this year was actually on the ETF for the Chinese stock market. So that's where we try to focus on those key turning points, because that's where you can really get the biggest bang for your buck.
Hey, Matt, can I ask you what the hold time was for some of these leveraged ETFs?
Anywhere from and the ones that we highlighted, They were all at least a day.
Okay.
But
So very nice and quick.
very
swift
nice and quick,
rhythm.
couple of days, sometimes a couple of weeks, but most of these are sure. I'm trying to get those when things get completely washed out,
Great.
completely too elevated. I mean, one of the things I did this year on Apple Computer, we had a thing in May. Apple Computer was getting was getting crushed, and it was down 10% in just a couple of days. I'm like, there's no news out on Apple Computer. I mean, I know the market's down, but Apple wouldn't go down 10% in just a few days on that. And I realized what was going on from my almost 40 years in the business. I'd seen other times when illiquid markets get forced selling, they get margin calls. They can't sell what they need to sell to meet their margin calls. So they have to sell something else. That's what we saw with long-term capital management way back in the late 90s. We've seen it other times. And I realized what was going on in May was that people were getting forced selling in their Bitcoin and their Ethereum, all their cryptos. They couldn't sell enough of that to meet their margin calls. Well, those guys didn't own General Electric or General Motors. They owned Apple Computer. And so what did they sell? A good big cap name that they could raise money in. They sold Apple Computer. So finally, on the day when finally the cryptocurrency market stabilized, we went in and bought Apple Computer calls. The next day, we sold them up 480%. Simply because I knew that once the selling subsided, no matter what happened fundamentally, this stock had to pop. So these are the type of things we try to look at in our chat room.
Great stuff there. Interesting analysis there and strategy there, Matt. So we're going to move on here to our next question. What opportunities do you have for people watching today, for example, right? Like, this is all really excellent. I want to thank you all for sharing your thoughts on the economy, markets, strategies, everything that we've been discussing here. Now, we've been absolutely flooded with questions from our Zoom and YouTube audiences, but before we move on to our Q&A, could you give our listeners some opportunities that you see today to potentially profit through this market shakeup, especially based on how the Fed meeting plays out? We're getting closer and closer to 2 p.m. Where do we go from here? And what should people at home do? Anne-Marie, let's start with you, and everyone feel free to chime in here.
So for us, what we've got set up on the platform this morning is something called a strangle. And a strangle is a put, which we were betting on the market going down, and a call, thinking that the market's going to go up. So we're going to buy both of them at different strikes. And because we've got increased volatility, I actually turned it into a long iron condor. But don't fret, that's, if you go, what is that? It's just a long bear put spread and a long bull call spread, and I jammed them together. I did that for the SPY and the Qs. That's going to help us if we happen to move up really far or move down really low, and we have completely structured risk. The big space I like to look at outside of these types of strangles and positioning in SPY and the Qs when things move around, I really think that the XHB, which is the ETF in the housing space, is going to have a little trouble, but we've just had a number of very good positions that we played there that have been short. It's come into a support zone, and it's really not going any lower. So that tells me that a base is forming and people are going to try and lift it on the horizon. So I believe that housing starts might have been bad, the number a couple of days ago, but housing completions were a little better. We're supposed to really look at housing starts, and those continue to lag. And so my thought is, if we have a good bounce, we're going to be going short there again. So the bounce from, say, the 63 area back down into the 56 area and below. Not right now, because it's basing. And I like that, particularly as a space that makes sense to people because, well, if interest rates keep going up, it's going to be harder on the housing market. And so all the things sitting in there are going to have a little bit of pressure on it. So the bounces I'm going to continue to sell in the XHB.
Interesting there. And let's see if we can get, Matt, what opportunities do you have for people watching today?
Well, and I don't want to steal any thunder from Chris, and I'll let him go into more into details, and he may not even care on this, but I just think looking at the VIX, we're buying some options out to towards the end of October. I just think volatility has a good chance of spiking a lot higher at some point, and you know, and you know, there's people. I think it can spike above 40. I guess is my point. So I think that's a way. Now, be careful about the VIX. Is it because when the market starts going down, the VIX doesn't spike immediately. That's not when people panic, right? People panic after it's gone down for a while, and then all of a sudden it spikes way up. So that's why I've gone out quite a few, quite a few weeks, 6-7 weeks on that. The other thing to look on a very short-term basis. Now, I already have it set up, but it's very small right now. I think maybe even later today. But when I said everybody gets on one side of the boat, everybody is bearish on the bond market. Okay, and everybody's looking for the TLT, which is the Treasury Market ETF, looking for it to go down further. In other words, they look for the price of bonds to go down. So that means yields. They're looking for yields to go higher. But everybody is on one side of the boat. The TLT is oversold. If you look at the yield on a chart, the 10-year yield, it's very overbought. So I'm buying TLT calls, believe it or not, very small. But if we get a spike higher in rates after today's announcement, which will mean the TLT will get hit hard, I'm going to get more aggressive on those names because it'll be a short-term trade. Believe me, I think interest rates are going longer. I'm sorry, interest rates are going higher over time. So this will be a trade. It'll just be a few days old, but no market moves in a straight line. I think a lot of people are going to be surprised. Maybe it doesn't come till early next week. But at some point in the next few days, I think we're going to see a big spike in the bond market. In other words, in yields coming down. It's going to catch a lot of people off sides, and it's going to be a nice opportunity to make some money in the TLT calls.
Interesting there. Chris Capri, I'd like to get your take on this. What do you think are some good opportunities for our viewers? I know you check out the flows and all that.
Yeah, so like Matt, I'm with you on the VIX here. We're seeing the same thing. So we have a VIX bull call spread right now that's already open. We opened it several days ago. We are expecting a spike in VIX as well. It's a combination of we're expecting this, but we're also using it as downside protection in case the market does sell off. Then VIX should spike, and so we want to take advantage of that. So looking at the flows and SPYs right now, I'm just kind of looking at my notes and everything like that. I'm going to make kind of two predictions here, so to say. I'm going to make an end of the month prediction for September, and then I'm going to look out further into, say, the October OPEX based upon the flows. So if we get a bullish FOMC out of this, and I don't look at the FOMC as like one-dimensional based upon the rate hike. I look at it as three-dimensional. Rate hike, statement, and then the press conference after, because we've noticed that the big moves post FOMC haven't been on the announcement or statement itself. It's been when Jay Powell, who I affectionately call the human Xanax, considering how boring he is. You got sleep problems? Just listen to Jay Powell. Put it on your earbuds at night. You'll fall asleep, no problem. Had coffee an hour before, you'll fall asleep, no problem. So with that being said, I'm looking at the flows on SPYs, and I think by end of the month, SPYs, if we get a bullish one, we can get a move up to 400, partially because of the heavy long puts. We expect IV to come down then, and that will force some short covering, and that creates about enough room based upon the flows up to about 400. Beyond that, we're not seeing much call interest above 400 till the end of this month. Looking further out for the bull case scenario, if it does happen, looking at the October market, we could see the market moving up to like 415, 420 if we were to get a really bullish, but it would have to be something that really placates the markets and assuages their fears. Anything above that, and anything less than that, we don't think we're going to kind of get that break beyond 400. On the bear side with SPYs, we could see markets looking at the flows. We see strong put interest down to about 370 towards the end of this month, but the flows come down significantly below 370. There's just not enough fuel as is right now. If the FOMC comes out hawkish and traders start searching for puts beyond that, then we're targeting, say, the yearly lows, which is like 362, I believe, in change. Looking a little bit further out to the October OPEX or maybe December OPEX, we could easily see a move past 350 and potentially start reaching towards like 330. But the flows aren't there yet. So the flows are lined up end of the month. Then we see a lot of interest around the October expiry, but very little in between that. And then we see December. And on the call side, there's just very little interest beyond 400 right now. So to really get these extended moves, we're going to need to see these post reactions where traders are buying up calls, not just further up in strikes, but further out in time. That's what we call laddering up. So if we see the calls move up, further up in strikes and further on time, that's laddering up. And if we see the puts come up, then that's a doubly bullish signal for us. But if we start seeing them ladder down, then we would expect these ranges to start to expand. So that's kind of what we're seeing right now in terms of SPYs and VIX.
Interesting there. I always love that analysis.
Fascinating.
Sorry, go ahead there, Anne-Marie.
Oh, no, I just said fascinating.
Oh, yeah. And
stuff.
Mr. Tim Melving, any good opportunities out there that you see?
Well, we see some developing. All right. I mean, look, the market is not what I would call classically cheap here. All right. We're not even, remember, we got really overinflated on valuations in 2021. So we're still trading at about a 19 multiple on trailing 12-month earnings. You gotta figure earnings are going to be lower in the third and fourth quarter. I'm thinking 4 to 5% lower, at least for the S&P 500. And the multiple is going to continue to come down. So we're not hyper aggressive. We've added a few stocks where we have high conviction, but until we see high yield credit spreads, my favorite fear and greed measure, pop over that 7% level, which seems to be the magic point. It doesn't always nail a bottom, but you're always really happy with your purchase when the spread's at that level 3 to 5 years later. Historically, it's been a great time to start being an aggressive buyer. We're at about a 5. We'll wait for a 7 to get aggressive, but look, you've got to look out there. Tech forward banks, you can buy a lot of those now because banks do real well in a recessionary environment. Loan demand goes down. Credit quality, they keep telling us credit quality is going to get worse, and it never does. Every quarter, I said, well, it can't be any better. And every quarter since the pandemic, credit losses have been better. It's been spectacular, actually. But the banks that are really embracing technology are going to have a massive advantage over banks that don't. And they're going to take market share because after the pandemic, even grandpa wants online banking. Okay. He wants all those digital bells and whistles. He just realized that the coffee in the branch is really terrible. And you can place the same order from a better coffee shop on your bank, on your digital app for your phone. So there are some banks. I'll throw out one name for free. I can't give you too many because they're for paid subscribers, but Customers Bancorp, CUBI, has done a fabulous job of embracing and banking the fintech world. So that's one area where I'm starting to get pretty excited. The other, semiconductors, all right, and semiconductor capital equipment companies. Think about any trend, guys. I don't name one. Smart cities, smart cars, artificial intelligence, big data. Pick something. Everything in this house now, with the possible exception of this pen, and it may have one, has a semiconductor chip in it. The entire future is going to be based on semiconductors. Yes, we have a massive supply chain shortage right now. And if you look at what it's done to Intel and Micron and earnings of some of the other big companies, it looks pretty bleak. That's going to change, guys. You've got Intel and Brookfield now working together to bring the semiconductor industry back to the United States. Micron's doing the same thing. They're getting out of the East and into the US and the West. This is a massive change, guys. And so again, taking that 3 to 5 year viewpoint, you can't do anything on the electric car front. You can't make any advances in quantum computing, artificial intelligence, anything without more semiconductors. Once this shortage is over, more semiconductors means more revenue for semiconductor companies, which means more profit growth. These things are trading at single-digit earnings multiples of depressed earnings. I'm not going to say that you could go out and buy them today and they won't stop going down. In fact, I bet a large amount of money that early buyers like me in this space are going to experience losses before we experience profits. But the profits are going to be massive. And then my total contrarian play is actually goes against Anne-Marie's short-term thesis on home builders. Guys, we came into the pandemic short 2 to 3 million homes. Okay, in demand.
That's true.
That demand is, that shortage is now over 5 million homes, and it's almost entirely on the low end of the market. Okay,
that is true.
It's millennial family formation and the generation, whatever we call the generation behind the millennials, they're getting there too. Okay, it's suddenly becoming much more important to think about shopping and schools and yards than where can I get sushi when the bars close at 2 a.m. So they're kind of getting out of the center cities. Work from home has accelerated this, work from anywhere. Why live in a 800 square foot apartment downtown in a major city for 4,000 when, you can buy a home almost anywhere in the country for 2,500, 3,000 a month, actually kind of getting to that point outside of the major cities. So home builders, and can't give you this ticker because it's going to go into the portfolio for paid subscribers. That wouldn't be fair to them. There's a couple of home builders that cater to the low end of the market, first time move up buyers, including one that's sitting on a massive inventory of lots. Guys, I don't care if it goes down after I buy it, because 5 years from now, I'm going to sell it for 5 to 10 times what I'm going to pay for it right now.
Stock market's pricing in what happened 15 years ago in the housing market, and that's not going to happen.
No, and look, if you've gotten married, you've got your a first child or a second child on the way, you're 35, 30 years old, okay? You don't care that the mortgage is 6%. And my parents had a 12.5% mortgage.
Yep,
We knew
mine
people
too.
that had 15. If you need to get out of the center city because you're walking around, and this is my son-in-law's exact experience when my first grandchild was born, he's walking around a very good neighborhood in Chicago, walking his infant daughter, and noticing that there were still needles and whiskey bottles, and even in this really good neighborhood in Chicago, and contemplating that, if a decent preschool was going to cost him 40 grand a year, right? He knew, hey, I got to get out of here. And he moved down to Southwest Florida, right down the street from us, which we're very thrilled with that development, believe me. But that decision's being repeated with literally millions of people. And here's another source that nobody's thinking about. I don't care how you feel about the student loan forgiveness. You just put a lot of money back into people's pockets. The National Association of Realtors estimates that loan forgiveness put 1.2 million new potential home buyers into the marketplace. So will it go down before it goes up? Yes. I used to work with a broker who, anytime I took a long-term position, he'd make a short-term bet against it. And then we'd split the money and go to lunch, because they always went down before they went higher. That's probably going to happen here. But again, more excited about that 10x return that I think I'm going to get on this thing in 5 years than I'm concerned about the potential for a 10 to 15% short-term decline. So that's kind of where we're looking, Rodrigo. I threw one name out for you guys, but the rest of them, we got to save those for the folks that are writing some checks to do some business with us.
Right. No, I totally understand that. And
great.
folks, you guys have been blowing up my email, my phone, and some questions about how you can pretty much follow up with Tim, with Anne-Marie, with Chris, with Matt. Look, I understand, folks. We're going to talk about this right now because a lot of you guys that want further insights into what our top analysts are recommending, the exact trades that their subscribers see every day or week, right? We've created our newest trading pretty much platform for you guys, the New Era Wealth Kit. So because the market is changing, the next few years, you're going to want to have people like Matt, Chris, Tim, and Anne-Marie on your side. They all have come from different backgrounds. As you can see, we ran over their strategies. We ran over things they look at in the markets within the time that we're allotted here, of course. So instead of trying to navigate the new era of investing and trading on your own, or as they say, wing it, right? This is a way that you can follow our top analysts, their best ideas in a completely foolproof way. That's pretty much means you'll be there with them the whole day, right? Together, there's 4 different items for you, right? All of our best ideas, from analyst packages to research platforms, including Benzinga Pro. But first of all, we're offering you the full access to the same platform itself. Benzinga Pro, it's the #1 tool out there for research. All these folks use it. It's a place where you can find everything you need on stocks, options, calendars, scanners, actionable stock news, trading signals, everything you can imagine you can do in there. And more importantly, your entire portfolio, right? You can pretty much connect your portfolio directly from your brokerage. It runs through all the screeners to make sure that you're only holding the best recession-proof stocks. Plus, you get access to Anne-Marie's chat room, where she's posting the exact trade setups that she's looking at every single day. We're also going to give you exclusive access to our Benzinga Pro Insider Report, where every Sunday you'll get a premium market briefing letting you know exactly what we're looking for over the week ahead. Tim Melvin's Growth Investor, where you'll find a portfolio of Tim's 7 favorite stocks you could buy today, each with a full write-up, okay? Each with a full write-up. Just, it's pretty simple, right? Even a sixth grader could use it. But Tim doesn't just stop there. He'll also send you 2 video updates every single month so that you can play them while you go about your day and get his exact thoughts on the existing positions in his portfolio and the current state of the market. Next, we're giving you access to our most popular service, Benzinga Option School with Chris Capri. As you've heard today, Chris really knows his stuff, and this is your chance to learn options trading from a Wall Street pro. He holds live classes and has office hours every single week, pretty much like a real college professor. So if you're serious about becoming an expert like Chris, this is a must. It's a must. Also, like you heard, Chris says today, he's always looking at order flow. That's why every Sunday, Benzinga Option School members receive a weekly options flow report. If you don't know what that is, don't worry, Chris Capri will explain that to the bone in detail in the school. And that is written by Chris Capri. So pretty much that's everything you're going to need to learn to be on the winning side of the option trades and pretty much, penetrate those markets, right, with the sentiment as a whole. And last, but certainly not least, full access to Matt Maley's Inner Circle. This is an exclusive chat room Matt holds every single day. He will post trades, analysis, entries, exits. He'll give you the ability to ask him questions directly at any time. Even though Matt, you'll see him on the news, CNBC, Bloomberg, all that stuff. He's there in the chat room live all day with you folks, 9 to 5. So it's a great conversation approach there. So if you do want to have access to him live the whole day, that's great. Plus, let's also not forget, you're going to get access to Matt Maley's stock picking and swing trading service, where he posts at least 6 new trades every month and has 3 live conference calls every single week. 3 live conference calls. The same types of calls that hedge fund traders, portfolio managers, and their analysts have every single day. All of this access is pretty much like having a direct line to all of our panelists. Yes, it is for the full year, my friend. So we've put together an incredible package here for you so that you can get it at, pretty much like at a one-time kind of thing here, okay? It's we're going to put the link there in the chat because I know a lot of you folks are asking about this. So we'll have some of the producers post that link and the right email there as well. And you can just use that to pretty much enter there and have immediate access to our panelists. And also, let's just mention this really. Our trading and research workstation, will come with full access to Anne-Marie, a 7-stock growth and value portfolio from Tim Melvin, a college-style education on options and live actionable trades by Chris Capri, and full access to Matt Maley's chat room, stock picks, and conversation approach, right? All of this, we're pretty much going to put it all there in the chat. It's the same link. We're only doing this 85% off until midnight. But now we've gone through pretty much a whole bunch of stuff here. Let's start answering some questions from the chat members. All right. So I have some questions here ready that you guys have sent. By the way, thank you for sending them. And if you have any questions, send me an email, right? Send me an email, call me, leave a voicemail. Don't worry, we'll get back to you. So we have question number 1 for my friend here, Mr. Chris Capri. When you said pay attention to the options market, do you mean open interest on SPY contracts, triple Q contracts, VIX contracts, or something else? Chris.
Yeah, it's a great question. All of them. It depends on what you're taking. If you want to trade tech, then you want to be obviously looking at Qs. You got to understand that a lot of the tickers and Qs are in SPYs, so they are going to kind of interpenetrate each other. They're going to influence each other. But yes, it's not just open interest though. We have to look at, at like one expiry. You have to look at all the open interest across all expiries. So I have a proprietary tool. I can't share that, but I do share that information with the Benzinga Option School members. And I am working on with the Benzinga team trying to build apps so that everybody can kind of see that in the Benzinga Option School. But yes, you have to look at open interest. You also have to look at the cumulative gamma, the cumulative delta in the market. That gives us information outside of the open interest by itself. So there's a lot of flows that we're looking at on a day-by-day basis. Yes, great question.
And just for everybody to get a sense of that, that's pretty much what Chris will be doing during the option school. Any question at any point, we're just trying to give you a feel and you're going to get the same professional, actionable response from Chris. We have our next question here for Mr. Tim Melvin. Is global oil consumption going up on a per capita basis too? Example, growing faster than population.
That's probably growing in line with population growth around the world for the, I'm looking much longer term, but yeah, oil demand is still going to go up for decades, guys, just because of, increased population growth, particularly in emerging markets. And the thing that I find hysterical is you've got one agency, the government, telling you that that's what's going to happen, while others are telling you that they're going to end the carbon fuel business and get everything to 100% renewable. So yeah, oil demand is still going to continue to rise literally for decades, even as production is declining.
Interesting there. Thank you, Tim. We have a question for Mr. Matt Maley. Given the looming energy crisis in Europe, how do you see natural gas and energy stocks playing out?
Well, I mean, the thing with natural, I mean, of course, if anything happens where the sanctions in Russia on Russia disappear, when the facts change, we've got to change. But I don't see that happening. We hear this stuff about how Putin's losing a lot of support. Well, I mean, what do you think we're gonna get some real nice guy to come walking in and taking his place? Even if that happens, we got a long way before those sanctions get taken away, at least in my opinion. So this whole natural gas issue is so important. I think natural gas prices are going to go higher, but the problem, of course, is that every once in a while you're going to see the spike lower because of the for whatever reason, these technical reasons pop up. Like I said, people get too far to one side, and then some news flash comes out, and everybody thinks, "Oh my gosh, the whole war in Ukraine is going to end tomorrow," and it comes back down. But the point is, I am a bull on natural gas and on the energy stocks. Again, even it just goes back to the underinvestment we have had in all these issues. And now, don't forget that how important natural gas is to the development, to the production of fertilizer. I mean, it's not just heating your home. You need natural gas for the Europeans to eat. Okay, it's not just eating their homes. But the point is, I do think that the energy stocks are going to do well. I turned bullish on the energy stocks way back in October of 2020. Not one of these short-term trades. Everybody was on this one side of the boat. Everybody said that you had to sell this thing. Fossil fuels we're dead. For the issues that Tim and I have been talking about, I said just the opposite. Started pounding the table. You got to buy these stocks. You got to buy these stocks. And I think that I can continue to like them. We had Lee Cooperman was on yesterday on CNBC, and he was talking about how many of these stocks, and I totally agree with him, and I just like to get a lot of credibility from a billionaire, that they're trading like these energy stocks are trading like oil is trading at $60. Yep. Okay, oil may come down, fluctuate around. I think it's going to go back higher as we go into the winter. But even if it stays at these levels, it goes a little bit lower. These stocks are still cheap. So I am a bull on the energy stocks overall. Every once in a while, I'll pull back and maybe we'll buy the ETF, some puts on the XLE for a short-term trade for a week or two. But other than that, I think these stocks are still cheap. They're still somewhat overowned, nowhere near as underowned as they were in October 2020. But I'm bullish on the overall sector. And just to go back one thing really quickly, because we're talking about commodities, and is that what Tim talked about with the housing situation. The home in 1970s, home ownership was a good inflation hedge. People kind of forget that. And the other thing, as I said, is that people are pricing in the kind of disaster we had in 2006 or 7. That's not going to happen in the housing industry. If we have a real big disaster, it's going to be in commercial real estate, not residential real estate.
Right. Interesting take there. And we have our next question here. I guess that we could do it for all of us folks here. Let me pull it up. So next question, we had a couple of people asking about Ford and GM as a panel, right? As an entire panel, how do we feel about Ford, GM, the industry? Open-ended question here for everybody. Chris, Matt, Tim, Anne Marie.
I mean, I'll jump in first. I've never been a GM fan, but I think Ford probably wins the electric truck race over time. I know they're having supply chain issues. They just pre-announced horrible earnings. The stock's getting beat up. I'm in no big rush to buy it, but if I was going to buy one or the other, I'd buy Ford over GM every time.
Yeah, I think these F-150s, people just love them, and I don't care how much money you have, how much money you make, whatever. If you're got a lot of money and you want to buy the souped up one, that's what you buy. But if you don't have as much money, you still save on other things, cut back on other things, so you can buy that. And they're coming up with with an EV model of that. Oh my God, that thing is going to do well. So I agree, though. They still have their issues that they're facing right now. I wouldn't back up the truck and buy the stock.
No.
And one thing I would say though, is if you do buy it, don't be afraid to add to it at higher prices. And I'm just looking at the chart right here. It got right to its 200-day moving average and came back down. If you buy it here and it goes, and then the whole market comes down, you buy a little bit more, and the market goes back up, and it goes through 16. But right now, the 200-day moving average is about 16. Don't be afraid to buy more. Don't be afraid to pay up. He says that. Do you think that Peter Lynch, one of the greatest portfolio managers in history, didn't buy stock here and kept buying it? He went higher because he had more money coming in. Don't be afraid to add to winning positions, especially early on in the rally. And that's one key thing. It says that you buy some a little bit now, you buy a little bit more when the market comes down, like most of us think will probably happen. But don't be afraid to add positions, because you'll be adding to a winning position. There's nothing wrong with that.
I have to agree with Tim and Matt. If I choose between GM and Ford, I would choose Ford. One thing we have to understand is that Ford had, prior to EVs, had a pretty dominant share of the truck market. There were a lot of buyers who own the F-150 as this incredibly popular truck. So we have to look at the fact that those truck buyers, that when they do convert to the EV market, if they like the Ford F-150 before, they're going to love the Lightning, the EV version of it. So we have a lot of potential buyers in the pipeline for EV. Also, one of the things about Ford is there's a lot of contracts on Ford, heavily traded in the options market. So maybe, you want to buy it and maybe you're worried about the short-term fluctuations. That's where we use options to hedge and neutralize risk. You can get long stock and sell premium against that. You can get long stock and buy puts or put spreads to neutralize some of that downside, so that when the market does eventually stabilize and go up, you have reduced your cost basis on it. So maybe this isn't the bottom in terms of the stock price itself, but that doesn't mean that we can't start accumulating some at this price and make some money while the options while the market consolidates or goes lower. So between the two, I'm definitely with Ford on this one.
Interesting take there. And we have another question here. By the way, great questions, folks. We have, all right, let me just pull this one up here. 1 second, folks. So do you guys think the market would go up maybe intraday today, despite the Fed being hawkish? Is it a sign of a possible sell-off after the Fed rate announcement? What are y'all's overall thoughts on this?
I mean, anything can happen, and there's a good chance it'll happen in both directions. You can see a big move one way and then a turn around and go back the other way. We've seen that several times on Fed Day. We've seen it several times when Jackson Hole or when the CPI basically went straight down. But be very, very careful about drawing any conclusions between 2 and 2:30, especially until we really hear what Chairman Powell has to say, and then to see how the market reacts. The one thing I will say, though, is we do need to be careful that the market's getting oversold. It's not crazy oversold. If we do get a spike lower, maybe you see about turnaround Tuesdays. If things really get hit hard into next week, we are getting oversold. No market moves in a straight line. Be careful about holding on to bearish positions for too long, because you get that thing to bounce back right in your face really, really quickly. I expect it to go lower. A lot of people are expecting. It's so funny. People talk about every bearish as this, but the market's actually lifted a little bit the last few days. The setup here is not for unless he speaks really dovishly, and I just don't see it happening. I see the market going lower. The thing I'm looking for is what Bill Dudley said today. The most important person in the Federal Reserve is the Federal Reserve Chairman. The next most important person is almost always the president of the New York Federal Reserve, not the vice chairman. Sometimes the vice chairman is just as important as the New York Fed president. In this case today, that is true, not always. However, the guy who just had the job or used to have the job, the most recent person to have the job, is saying higher for longer. That's going to be the message. If that's the message we get, I see the market going lower over the next few days. But be careful about loading up after a further downside.
Interesting take there. Interesting take there. We have one last question here for the panelists. Any opinion about the payment space, for example, PayPal, Square, all that sort of stuff?
I can jump in this one. Oh,
Okay.
Tim, do you want to go first, please?
Yeah, it's just super competitive, not yet cheap enough to be an aggressive buyer, in my opinion. I mean, PayPal's a great company. I'm more interested in owning the banks that are funding these guys than I am in owning the outright companies because of how competitive it really is right now. Will we get to a point in time where I want to buy them? Yes, we're just not there today.
I'd echo those comments.
One thing I want to mention about that space is that I do think that, these companies like pay as you go or pay later, buy now, pay later, I think we're going to start seeing regulation come into this space. And that's going to obviously have effect on some of the margins of some of these players. So, there's already discussion about potential regulations in the pipeline. Once regulations come in, it's going to shake out a lot of weak players. And then only the ones who have the stronger balance sheets and are able to comply and really shift and handle those regulations are going to survive.
Yeah,
so I think there's going to be a lot of volatility in the space in the next 6 months to a year.
The FDIC said last week that they intend to regulate them just like they do credit cards. So that, and you're right, that puts a whole bunch of people right out of business quickly. So be really careful speculating in that space right now because that could all go away quickly.
Right, but as you say, is at some point it's going to be great because in all those
at some point,
when the weak ones disappeared, the good ones are going to do really well. So there will be, like you've said, Tim, there will be a great opportunity down the road.
And that's how I view just about everything, by the way. So Richard Rainwater, who you can Google him, but a guy whose career I studied and I learned a lot from. He worked with the Bass brothers. He said, the traditional way of investing is you buy a portfolio of stocks and you sit around worrying that everything's going to blow up. Whereas Rainwater's approach, which I've adopted, is I wait for stuff to blow up and then I go buy. So I think that we'll see some wreckage in that industry and we'll get an opportunity there.
Warren Buffett's been doing that for 80 years. Exactly.
Oh, yeah. He's been doing it since he got too big to do the special situation stuff that made the first billion.
Right.
So,
Yeah, absolutely. Great take there, folks. And well, that pretty much takes me to the last question that we have here. I do want to thank everybody here for their time. Matt Maley, Chris Capri, Tim Melvin, Anne Marie. I want to thank everybody here for being here. I know this has been a very informative session. We've definitely covered a lot of topics. And I want to make sure that we properly, right? We properly thank everybody here. Proper shout outs and all that stuff. So just give me a quick second here, folks, really quick. Okay, so I was told not to do this, but we'll do it because, we definitely had a great session. Big shout out, Tim Melvin, Matt Maley, Chris Capri, Anne Marie. Let's go. Amazing session here. I had a great time, folks. We definitely enjoyed this. A lot of knowledge, a lot of information. And look, if you guys want to continue this path, right, with our top analyst, you can do that. I'll stick around here for a couple minutes showing you everything. But I definitely wanted to thank each and every one of you panelists for being here, for putting your time into helping the retail trading community. We appreciate it. I appreciate it. Everybody out there loves it. Definitely big thank you for you guys.
Good luck to everybody out there. Good luck. It's going to be there's a lot of opportunities out there. Good luck with it. We're going to do real well when a lot of other people are having a tough time.
Yes, absolutely, folks. Thanks a lot for being here, Matt, Tim, Chris, Anne Marie. And I'm going to proceed here to just show you more or less what we're working on here. This is the new Wealth Era package. We are posting the link for everybody here that wants to join. Somebody that really wants to take on right, the stock market by the horns, literally, okay? You're gonna have everything from active options trading with Matt Maley, buying calls, buying puts, short near-term swing. And you're also gonna have those medium to long-term setups with Anne-Marie, Chris Capri, 4 types of spreads, condors, butterflies, diagonals, you name it, all that stuff. And for everybody that really likes value investing, Tim Melvin is your guy. If you're the kind of person that maybe is like, hey, I would like to put maybe 5,000-10,000 aside for my kids' college fund on stocks that are high quality with good free cash flow. When you're looking at really, putting your money to work for you and not do options, right? Just stocks. Tim Melvin is your guy for that. So he's going to be giving you pretty much access to the full portfolio. You get access to Anne-Marie's trades, Benzinga Pro, which has a ton of tools, pre-market scanners, aftermarket scanners. If anybody does have questions on this, like package stuff, right, put them in the chat. But my suggestion really is to send me an email. We've been posting it there in the chat. And basically you're getting 4 subscriptions total. Well, actually more than that, but we're just making it into one for this special deal. We know that a lot of investors need help at this moment. And that's really why we're doing this. We've never done this sort of event out there. You know how it is. But honestly, I think it's great because everybody was able to get a good sense really of what our top analysts are looking at. And they all pretty much have their own way of coming to a similar conclusion, right? There are traders, like for example, I do love about Chris Capri that he looks at the options flows. Chris Capri is a former hedge fund broker, and I'm not talking about a stock broker, I'm talking about an options broker. He's been on the buy side and the sell side, okay, from the institutional side. So he looks a lot into the delta hedging and things and terminologies that most people have not heard before. You have Matt Maley, chief market strategist at Miller Tabak, 40 years in Wall Street, started at Solomon Brothers in the early 80s. And that was like the most important trading desk out there, like for a decade until they got bought out. Then he was a director at Merrill Lynch, okay, managing 2 of the biggest funds in the world, Fidelity and BlackRock, then chief market strategist at Miller Tabak, and lead expert trader at the Stock Picks Inner Circle chat room. So Matt has an amazing track record. I love going through his research. And what he does is that he gives institutions his research. As a retail trader, you get that. You already know you're on the right track. Anne-Marie is amazing with butterflies, condors, all these sorts of option trades. I do them myself. They're in the pro chat. Literally, you just open the chat. So I can tell you it's a great benefit for everybody there. And Tim Melvin, of course, you already know he has that long-term perspective. So if we have anybody here that is not a day trader, not a swing trader, just wants to find high quality stocks, Tim Melvin is your man right there. So folks, I just want to say thank you for everybody for being here. We've posted all the information there. Make sure that you can give me a call, you can send me an email, whichever one works. As I was mentioning, I'm just happy to be here with you today and pretty much give you guys this great opportunity with our top analysts, right? You have everybody there, Tim Melvin, Anne-Marie, Chris Capri, Matt Maley. So folks, I think this kind of wraps it up for this session. I had a great time with everybody here. I hope that I can see a lot of you folks in the chat rooms because at 2 p.m. in about 10 minutes, this guy is about to start talking, Powell. So a lot of you guys, when you sign up right away, my suggestion for all you, people that did sign up recently right now, my suggestion is to just get into the chat room ASAP. Get into Matt's chat room, get into Chris Capri's live trading room. He does have a live trading room. Just get in there and just start, because keep in mind, we've been scoping this date for months. We trade around Fed events. We trade around these sort of things that happen in the markets, especially Matt. Matt loves volatility. And we're about to have some in about 10 minutes. So folks, if you're really starting to, do all this stuff, there's no better place to learn. If you're new, advanced, full-time trader, part-time trader, it doesn't matter. You're still going to benefit from this. I promise you. So folks, big thank you. We will see you in the chat room. Thanks a lot for being here. My name is Rodrigo. And if you have any questions, we've posted the link there in the chat. We're going to let the stream here run for a couple more minutes if you guys have questions, but we'll throw in the number and email for you to contact us. Salute to everybody. We'll see you guys in the chat room.